Hey, thanks, Sam, and welcome, everyone. Thank you for joining us today. We're going to be talking about a proposed rule from the Consumer Financial Protection Bureau that we refer to when we're talking to other bankers as the Loan Originator Compensation Rule. But what you'll see as we go through the material is that, yes, a great deal of the proposal deals with loan originator compensation. But there are also other facets of the rule that deal with everything from points and fee restrictions to mandatory arbitration. So we're going to go through step by step and talk about what the restrictions are that they're placing on upfront points and fees, and just as importantly, what are the exceptions? Under what circumstances can you charge those? You've heard people refer to the 0-0 alternative. We'll tell you what that is and under what circumstances you have to offer it. We'll talk about on points and fees that a customer is paying up front, what the customer will need to receive in order for you to charge those. We'll cover affiliate fees. We'll talk about the manner in which you can compensate loan originators, and what you're going to see is there are a lot of different approaches to that, and Jack, as he goes through that part, will help you key in on, okay, this is the route that you're going to take so that you can drill down into the details on that, because there are lots of permutations and variations. We're going to talk about how they have revised the restrictions that relate to pooled compensation, profit sharing, and bonus plans. We're going to talk about how they've built into the Truth in Lending Act some tweaks that are really SAFE Act related that apply to loan originators, mortgage loan originators that are required to be registered under the Act, and they're bringing in some slightly amended versions of the requirements that apply to licensed mortgage loan originators. And it's important as we go through here for us to point out to you which of the things we're talking about apply to closed-end credit, which apply to open-end credit. Everything we're going to be talking about today relates to consumer credit transactions, and these new provisions are going to apply to most mortgages. When there is a particular provision that only relates if it's a consumer's principal dwelling, for example, we'll point that out, but most of these apply to all of your mortgage loans. So the proposal is from the Consumer Financial Protection Bureau. We have the link on page 2. I always save about 10 characters by just typing in cfpb.gov, but there are several different routes to go to where you're going. All of this is under Reg Z. So remember, in everything we're talking about, unless you have a loan to a natural person, primarily for a personal, family, or household purpose, it's not going to be covered by this, or unless your loan originators are working on that type of loan. The proposal is a lengthy one. When the CFPB came out with it, it amounted to 369 pages and dealt with everything from financing the single premium on credit insurance to record retention on your compensation records. So the comment period is coming up in I guess that would be next week from when we're broadcasting. We truly believe we will see regulations on this by January 21st of 2013, because if they don't adopt rules on this by then the statute goes into effect, and they don't want that to happen. They want to set the timing. So with that, Jack, I'm going to turn it over to you.
All right. Well, we start off with some definitions. And, Mary Beth, I look at what they've done here on these originator compensation rules, and I wish they were a lot less complex.
Yes.
But, I think they kind of need it to be. I mean, it's, you're screwing around with somebody's compensation package. You got to be pretty darn precise about when you can do it, when you can't do it. And some of the areas they've got in here where, if your mortgage revenues exceed a certain level, you can't pay it. And, I'm not sure how you handle some of these issues from the contractual standpoint. You hire somebody and say, okay, we'll pay you a base salary, we'll give you a commission based on this, that, or the other. And, if it's tied to the terms, you can only pay it if revenues, it just gets, I don't know how you put all that in the contract.
Well, you certainly would want a sentence in there that says this contract shall be binding upon the parties except to the extent that any of the provisions would be prohibited by law or regulation, so that you would have an out there if you were granting something to the loan originator that this reg would prohibit you from paying.
Mm-hmm. I mean, when I look at this, I think I would be awfully tempted if I was running a bank just to pay everybody on straight salary. I'm a big believer in incentive compensation. And whenever you're setting that up, you got to be careful that your incentive doesn't create some wrong-mindedness. I make more money the more loans I make. I don't care how bad the loans are. I'll make every loan I can make so I can make money. So you got to be careful you don't get into that mode. But I believe certain people are highly motivated by the dollar, and they will work a lot harder if their effort directly affects their own bottom line. So I'm a big believer in it. But I look at this stuff and I think, dang, is it worth it? And it's painful. Well, let's look at these definitions. On page 5 of your manual, we have a definition of loan originator. And I never was a fan of this term because it's so close to the SAFE Act term of mortgage loan originator. And the two definitions are similar but different. One of the things I want to remind you is under the SAFE Act, an MLO is a two-pronged test. You have to be involved both in taking apps and in offering or negotiating terms. Here, it's a one-pronged test. You're a loan originator if you take an application, arrange, offer, negotiate, or otherwise obtain an extension of credit. If you do any of those things, you don't have to do combinations of them. You do any of those things, and you'd be covered. So this could include an employee of the creditor. It includes all creditors. At least certain sections of these rules apply to all creditors. So, again, the concept's similar to MLO under SAFE Act, but it is distinctly different. We have two other terms down the page that are new. We have an individual loan originator, and then we have an LOO, a loan originator organization. The individual is a natural person, so a living, breathing human being who meets the definition of a loan originator. And then the loan originator organization is any loan originator that is not an individual loan originator. So, again, we have, example might be a broker who works for a brokerage company. The broker is an individual loan originator. The company that the broker works for is the loan originator organization. Your bank, in some aspects, can be a loan originator organization. So, some new concepts there for us all to play with. Over on page 6, and by the way, this whole first section does deal with the compensation issues. And these are amendments of rules that originally took effect back on April 1st of 2011. And there were some surprises in there, at least surprises from some senior management of banks. They were definitely caught off guard when the word started to drift out there that profit-sharing plans and retirement plans and 401ks were potentially illegal. Couldn't do it. You couldn't make a contribution to a 401k. You can't pay profit-sharing bonuses. Those are the big shockers. So when these rules were published as proposed rules a few months ago, this was information that a lot of bankers were on the edge of their chairs waiting for. We need to know, can we do these things or not? And there's a little good news in here and some not so good news. So let's take a look at it. On page 6 at the bottom, we talk about what I call the first rule. It's prohibited payments. You cannot pay a loan originator, and a loan originator cannot accept compensation if it's based on any of the transaction's terms. Okay, that's the rule, and that really hasn't changed since April of 2011. Over on page 7, fixed percentage, the regulation clarifies here that if you are doing a credit transaction and the amount of the loan is not